We're good. Okay, Danielle, we can start whenever you want.
Well, I wanted to introduce everybody to you, Mark. This is Mark Kohler. He leads KKOS, a boutique law firm that helps businesses structure. And primarily the interesting thing for us here is I have a lot of real estate investors. And it's super important that we all understand how we're going to structure our deals and make sure that our assets are held accordingly so that we can optimize our funds and we can also protect our assets and protect them from all kinds of different things. So, Mark, I'm going to let you jump in and just really drive the conversation here because you're the expert. That's why I brought you on. Thank you.
Well, thank you so much. I pinned myself. You might want to spotlight. I'll keep gallery going.
Hello.
There we go. A few of you, I say this humbly, may already be following some of my podcasts or YouTube channel or have my books. There's no one in the country that has more views, subscribers, podcasts, blogs, or books on small business tax and legal strategies. No one. And so Danielle pulled a coup, pulling this off, getting me on this call with you guys. Normally it's either money or big group or this or that, but I love what you guys are doing. And my social media manager, Kirby, really connected with your team and wanted me to set this time aside. Hey, Robbie, my backdrop's off. Sorry, our studio tech that's in charge. No one touched it. It's your auto turn off. So my studio guy's at a pretty serious doctor's appointment today. So so even though with your Zoom link issues, we had studio problems here. So thanks everybody for your patience. We'll go to the top of the hour, 45 minutes here. I want to rock your world. I wanted to share 2 or 3, maybe 4 or 5 tax and legal, because they go hand in hand, strategies for real estate professionals. And I want to do a lot of Q&A. We'll unpack anything you want. There's no sales pitch to a mastermind in Vegas for 10 grand, none of that crap. You might find out here real quick that your accountant is jacked up or your lawyer does not exist in this realm or universe. So I'll give you some resources to my tax advisor network. I train hundreds of CPAs around the country that speak Mark Kohler. They have to pay me and continue in weekly education with me to stay at that level. And then we have our law firm and our directed IRA trust company. So I'll explain those a little bit more as we go along too. So anyway, Danielle, thanks for having me here. And Danielle, anytime you want to cut in and go, Mark, stop it. Talk about this. This is what we need, or whatever. You just freaking rein me in. I'm a wild Mustang. So.
Okay.
All right. So I'm going to be honest too. I want to ask this of all of you here. And I'm not trying to be a prima donna. My time is so valuable. I don't even take personal consults. I've got 15 lawyers and 180 employees, and I'm booked constantly everywhere. If you're being here today, this is a huge investment of Danielle and the team. Turn on your cameras, turn off your phones, get engaged here. If I don't save you 5 to 10 grand in tax and keep you out of harm's way in a potential lawsuit, I failed today. Literally, I could calculate how much money I'm going to save you guys. So this is your chance at close to $500 to $1,000 an hour to have a real tax lawyer that's focused on real estate and small business for you. So please use this time wisely. Okay, so strategy number 1 begins with you all knowing what is called the trifecta. I would recommend for those of you that aren't driving, turn on your damn cameras and pull out a piece of paper. You want this. The trifecta is the way you organize your tax and legal world and bring it all together. So the trifecta begins down here with your revocable living trust, RLT. This is also where your 1040 is. So all money runs downhill in my world, like water runs downhill. Your money's going to run downhill into your 1040 tax return. We're going to split your life in half, and we're going to divide your ops from your assets. This is the most basic structure. These can get extremely elaborate very quickly to help build a structure that will blow your mind. I'll maybe show you some examples of trifectas. And when you do a consult with any of my tax lawyers around, when we serve clients all over the country, you'll get your own trifecta so you can build your annual plan for tax savings and wealth building and asset protection. And it's not 5 or 10 grand or some stupid retainer like non-lawyers charge. So anyway, just pay attention. You guys will love it. So on the operations side, this is where the realtor, the broker, the contractor, the developer, this is your world. We're not going to hold assets over here. This is where we're going to do operations. For any of you, which I know your group is this educated and successful, all of you are going to have an S corporation. If you're making more than 50 grand a year in ops, you're going to be an S corp. Now, maybe an LLC taxed as an S corp. Call it an effing S corp. Don't say, oh, I have an LLC. I'm going to go, really? That's stupid. Oh, well, it's taxed as an S corp. Then call it a freaking S corp, because you're going to confuse lawyers and accountants. So make sure you've got that. So this is an LLC. It could be a PC. It could be a PLLC. I don't care. I just want to make sure you're taxed as an S corp. This is where your 1099s, your broker and agent fees are going to come in. You could do hair and nails, drywall, broker fees. Do not care. I want to try to keep one S corp in your life. I can have as many entities as I want with my law firm. I have one S corp. That's all I want. Then over here in the most simplistic trifecta, you're going to have your LLC for your rental property. And that opens a whole other can of worms. We could have short-term rentals, long-term rentals, self-rentals, syndications, everything under the sun over here. Real estate professional costs, we get all that starts to play out over here. This is the trifecta: operations, assets, legacy. This is your trust for privacy, for your estate. Where's everything going to go? I want to keep my name off the grid. I want asset protection for my rentals, and I want a firewall between my operations and my assets. My S corp doesn't own anything. It owns a laptop. Sue me. You can have it. There's nothing there. But I want to start hiding your assets, protecting your assets. They go over here. Trifecta. Okay, that's the foundation of what we're going to be talking about today. Okay. Now, the first strategy all of you need to know is the S corporation. And you say, well, I'm already an S corp. Yeah, you could be screwing it up because you might have a stupid CPA that's got to stick up their butt and they're 60 years old still doing 1980 strategies. So you got to take the helm, be the captain of the ship, and ask your accountant some important questions. So let's explain why an S corp makes sense. It only takes 2 minutes. I'm going to finish with strategy 1, and then you guys can ask any questions. I go, Mark, that's crazy. You're stupid. My attorney says this. My accountant says that. Well, let's unpack it, because no one, again, has more blogs, more videos, more podcasts, more articles on this than me. So I want you to make sure you're getting the quality, perfect information. I'm licensed in like 5 to 10 states in all sorts of ways, backwards and forwards. So I want you to know I stand behind everything I say. So a brand new realtor, here's where they get jacked, or a brand new developer, a brand new fix and flipper, Chip and Joanna, whatever. Okay. They set up as an LLC or a sole proprietorship. So they make 100 grand. They have 25 grand in expenses. Let's say they kick it. We're doing auto, home office, travel, dining, computers, electronics, cost seg. We're writing off everything we can over here in our operations of our business, and you still net 75. That's a margin that's typical of many realtors, and contractors are going to have a very different margin because they have such a high cost of goods sold with materials and labor and all that. But a realtor, in and out. My daughter works at Sotheby's, love her. She's my little realtor. When she was 13 years old, we were sitting at the kitchen table, and I still remember when I said, you're going to be a realtor someday. She's like, Daddy, what's a realtor? I'm like, you're going to freaking love it. You're going to kick ass. She's adorable. She's 25 years old, beautiful, and she's just out killing it as a realtor, and I love her. All my kids, except my 20-year-old, have owned a rental property already by age 27. So I have a son that's 27. So I've been teaching this to my kids from day one as well. I want you teaching your family, passing on a legacy on these real estate principles. So anyway, if you have a brand new realtor, brand new cupcake shop owner, brand new landscaper, brand new rehabber, whatever, they bring in 100, spend 25, net 75. You've got self-employment tax. Are you hearing a little ping, ping, ping? Is that me, Danielle? Is that people coming and going? I hear a bing, bing. I don't know what that is. I don't know. Okay. So once you make this 75K, you've got self-employment tax of 15.3%. This blindsides every brand new small business owner. I had a dentist I was talking to the other day that's getting jacked up. That's 15.3% is 10 grand. Then you're going to pay state and fed. This is the problem. A lot of people think an LLC saves taxes. An LLC does not save taxes. Where the S corp comes in, I'll show you where, again, many of you that already have them could be doing it wrong, is we switch to an S corp. You could do an S election on an LLC. I bring in the same 100, I spend the same 25, and I net 75. Now what I'm going to do is take a W-2. I'm going to split this 75 into two pieces. I'm going to take a W-2 here and a K-1 here. And it's called, I call it the salary dividend split. I'm going to split this money up. I only pay FICA, the F word. I hate the F word. You guys should hate the F word, which is FICA, Social Security, Medicare. I'm going to pay that over here, 15.3%. But on the K-1, no Obamacare, no corporate tax, no self-employment tax. All I've got is the state and Fed. So in this equation, if I can push, in this example, I'll push 25 grand to the W-2 and 50 grand to the K-1. I made the same amount of money. You take a draw anytime you freaking want. I do not care. But quarterly, we're going to nail your payroll, and we're going to nail it at 25. Probably to keep things simple, we go 24. We're going to do 6 grand a quarter. You do your 941s. You're going to do those in April, July, October, and January. Many of you are already on that system. You shouldn't be doing payroll monthly. Whoever's ripping you off for that, we're going to switch to a quarterly system. So you'd claim your payroll, 15.3%. I just saved 15.3% on 50 grand. That's $7,500. By switching to an S-corp, I've saved $7,500. That's it. And the more money you make, the more you save. And people in California are like, well, I don't want an LLC because I got to pay $800 a year. Ugh. Okay, let me see. Yeah, the S-corp is going to cost you a tax return of $1,200. You're going to have to do payroll of probably $400 to $600 payroll service. You're going to be out $2 grand with an S-corp. By the way, to convert from an LLC to an S-corp, I can backdate you to 1/1/23, and it's expensive, super expensive to convert. We charge $200. That's it, $200 with a real law firm that knows what the hell they're doing. So you switch to the S-corp, spend $2 grand maintaining this, save $7,500. Now I know this is hard math. Spend 2, save $7,500. I think you're making money. And the more you make, the more you save. And guess what? The chance of an audit in an S-corp is 15 times less than an LLC. I'm actually giving you audit protection with this. And I can open the door to the solo 401k, board of directors. We're going to get kids on payroll. It's going to freaking rock. So let's open it up. Participant. So we can do quarterly payroll. Can we do annual too? You could. Annual's a little more risky because the IRS wants their deposits throughout the year. And I'll tell you honestly, as my realtors, you don't want a big tax bill in January. It's right after Christmas. If you're doing quarterly payroll, at least you're making quarterly deposits. So that way you're kind of on your game. So if you're going to do payroll of 24, you're just sending in deposits of 15% on 6 grand, which would be around $1,000 every quarter. Or you're going to get a big bill of 4 or 5 grand in January. How many closings are you having in January during the holidays, right? That's a lean month. Freaking A, let's be on top of it, having our quarterly deposits. You could do it annually, but now you've still got to do the reports. So you're going to be doing zeros 3 quarters out of the year and then pick it all up at the end of the year. So you're still paying your accountant to do the damn report because you have to, or the IRS is going to come after you. So be on top of it. Jennifer says, can I have my daughter on payroll who is age 28? Is there an age limit or any other limitations around this concept? Jennifer, I love you. We're going to go there. I'm going to go wherever the hell you guys want. So Jennifer's going to be our next topic. We'll come to that in a moment. Any other questions on this S-corp? People, the trick is you've got to nail down your payroll. And don't let some old fat white guy in the corner office of the CPA firm demean you and talk down to you, which they will do. You need to say, this is my tax return. If you don't get on Mark Kohler's wagon, you're fired. Here's how the payroll matrix works. It's called the Kohler payroll. Google it. I'm the #1 tax advisor for Entrepreneur Magazine and entrepreneur.com. I got articles and videos all over Entrepreneur on this as well. So this Kohler payroll matrix. This is the perfect time of year to nail this. Some of you may have it jacked up. We're in the 4th quarter now. We got to nail it before January. The more money you make, the less payroll you take as a percentage. So this is your payroll percentage, which I might start it out at 50%. I may do 40%. I may do 33%. I usually flatline all my clients at about 20%. Freaking Joe Biden in his S-corp the year before becoming president took a 5% allocation. I wouldn't have even signed that return, but apparently he has, big government looking out for him while Trump gets audited, whatever. But anyway, Joe Biden had an S-corp. He had a $13 million book deal. He took payroll of 700 grand. He saved over 500 grand in Medicare and Obamacare. Love it. People, every contractor, dentist, doctor, lawyer, accountant, engineer, broker, we all do this. If you're not on the bandwagon and understanding what your payroll is, you're losing money. So that's strategy number one. Any other questions on the S-corp? You guys raise a hand, come out and talk. Let me see how many people have their camera on. Let's see. One person has their camera on. 12 people here. Daniel, you're killing me, Danielle.
I know. I'm so sorry. I'm not sure what
That's okay.
happened.
Yeah, that's all right. People don't even know what they're getting sometimes. No other questions? All right. Oh, finally, Jennifer, gonna ask a freaking question. I love it. You look great. That's right. I'm only answering questions if you turn on your freaking camera. So Jennifer, this becomes your personal consultation. All right. Back to the trifecta. So in here, and if you type Kohler on Google, Kohler, pay your kids, I've got articles and videos, YouTube videos in the hundreds of thousands. You're going to want to meet with your accountant on this or find a better accountant. Here, and we're going to go to real estate professional in a minute, but Jennifer, you ask a question. This is Jennifer show. We can pay your kids under age 18 or over age 18, but we're going to do it in different ways. So we could pay them out of your rental property holdings, or we could pay them out of your operational. So Jennifer, I want to ask, do you have an S-corp already?
I do.
Okay. Do you have any rental properties?
I do.
Ooh, I love it. Which state are you in?
Texas.
Love it. Your rentals are in Texas as well?
They are.
Oh, cool. Okay. So we could get into asset protection. How many LLCs, what we put in our LLCs, how we maintain our LLC. That's a whole other asset protection. I have a whole other topics on that in articles and chapters of books.
I need an LLC to put all my rentals in. I don't have that.
Okay. We're going to go there next after the kids. So we're going to talk about the 4 options for rentals. You're going to love this. It's not a one size fits all. So we'll break it down. All right. So when we go to pay kids, we could pay the kids out of here, or we could pay the kids out of here. Now you look so adorable. You probably have kids under age 18 and over age 18, right?
She's 28 years old.
28.
Yes.
Jeez. Got pregnant when you were 10 years old? All right, whatever. Okay, now here's the deal.
Humidity in Texas is like, every woman's friend. So.
I love it.
That's why Texas women are so beautiful.
I hear you. I can see it. All right. Okay. So when you go to pay kids, for those here today that have kids that are under age 18, we have another structure. For kids that are 18 and over, it's a different structure. So forgive me, Jennifer, as I just build the platform for this. All right. If I have my S-corp, I would never pay my kids under age 18 directly. The reason why is I would have to 1099 them or issue a W-2, which I do not want to do. Because if I issue a W-2, I got to do pseudo FICA, workers' comp, the whole 9 yards. Not good. If I issue them a 1099, they've got to file a Schedule C. You are not required as an American with a small business to pay your kids under age 18 with a W-2 or 1099. They don't pay taxes this year on the first $13,850. This is now, I'm talking kids under age 18 for a moment. Under age 18. Well, okay, let's back up. None of us as Americans pay taxes, income taxes, on our first 13,000 and change. That's our standard deduction. So if my kid goes and works at McDonald's and makes 10 grand, they pay no federal tax. McDonald's is going to withhold FICA because McDonald's is a corporation, but they don't pay tax on the first 13. None of us do. So we'll come back to that. But when I have kids under age 18, I don't want to withhold FICA. So the trick is, this chapter in my book, the Tax and Legal Playbook, we're going to pay a management fee to a sole prop. We're going to set up a family management company. I call it an FME of FMC, family management company. This is going to be a separate Schedule C where I pay, when I had 4 kids under age 18, I paid one of them, let's see, I think one of them was $6,000. My twin girls were $4,000. And then Molly was $2,000. So there's 10, 14, $16,000. I don't pay for prom. I don't pay for school clothes. I don't pay for soccer. You shouldn't be paying for school tuition, help with a car, or anything. If any of your kids need money, you don't give them to them. Your company pays them. Now you're getting a tax write-off and pushing income into your children's brackets. And they don't pay tax on the first 13 grand anyway, at any age. So all of my kids get paid out of my company and serve on my board of directors. Your S-corp should be doing annual minutes. Jennifer, I won't put you on the spot, but if you're not doing annual minutes, and we have the new Corporate Transparency Act coming down the pipe, we got to report to FinCEN next year. We have a company compliance system. It's only $200 a year. We do your minutes and all this. On your minutes, your kids and your spouse should be on the board of directors. All right. This is what allows us to write off all these expenses when we pay our kids. So anyway, when my kids are under age 18, I kick out, in this example, 16 grand is an expense for management services. I pay all the kids for what they're doing, no W-2, no 1099, and I zero it out. I just got a write off for 16 grand for paying for school lunch. Quit paying for your kids' stuff. Pay them and take a write off and let them pay for their own shiz. That's how it works. Now, if I have kids that are 18 and older, they get a 1099. That's it. It's simple and easy. When my kids come down for Christmas dinner and we open presents on Christmas Day, they all go to their stocking and they get a 1099. Oh, it's adorable. They play with it for hours. They enjoy it. They get to play with it all the way up until April 15th and file their taxes. Oh, the lessons learned. So, but none of my kids get a freebie. I do not give my kids money. They get a 1099 for serving on my board of directors. Now, I'm going to give you the website for our law firm. You guys can get a consult, get a structure, get a trifecta, get on company maintenance, whatever you need. But this is where good asset protection plays in. This is audit protection, asset protection, tax savings. Just think of this right now. If Jennifer's going to help her daughter out with 10 grand, I mean, I won't put her on the spot, but I have 20-year-olds. She probably helped her out close to 10 or 15 grand last year. If we do this method, Jennifer just saved close to 30%. That'd be 4 to 5 grand in taxes right there. 4 to 5 grand in taxes. Plus her daughter should be on the board of directors, all of her travel to see her daughter, any airplanes. We should be having our board meeting and Thanksgiving and Christmas. Your travels are right off, all of the computers, the cell phones, any payments to your kids. This is one strategy. I have a 30 ultimate tax strategy guide on my website, markjkohler.com. This is one of them. One. And if you guys are expecting your CPA to roll out a red carpet and show you all this shit, they're not. You guys have to be the captain of your ship, pull your accountant in by the ear and go, we're going to do these strategies. And when they demean you and act like a dipshit and an asshole, excuse my French, that's what accountants do. They're condescending. They think they know it all. I'm one of them. I kind of, but I've been through therapy. So you want to bring your accountant and go, we're going to do this different from now on.
So Mark, I'm going to jump in real quick. Every time I listen to one of you guys, I learn something new. I just had this major epiphany that my daughters are away at college and I need to put them on my board of directors so I can expense all the trips back and forth. Thank you. This was worth it.
And you know what you can do, Danielle, is retroactively do that for all of 23. So now all the airfare you've paid for in travel and hotels, Airbnbs, Ubers, anything, you just got to write. I just got chills saying that. It changes lives. No, I mean it. It changes lives. The biggest stress in our life is finances and then sex. I mean, we can at least deal with the finance issue in a big way. All right. So we want to. So
okay,
finance,
everyone, you didn't know we were going to have comedy and tax advice. Here
you didn't? Matt Sorensen, my partner, is totally boring. You get a whole different track, here with Mark Kohler. Okay, I make it fun. All right, so Danielle we're going to add up all your fees and you're going to do backdated minutes for 2023.
Okay.
Oh, Danielle, you had a board meeting on January 1st, 2023. Oh, that's great. My ladies will type it up. You just put your kids on the board.
Okay.
Pen drop. All right. So Jennifer, this is how you're going to do it. Board of directors, 1099s when they're 18 and older. Every one of my kids, whatever they get, they know they're going to get 1099. All right. Okay. Next question. Can we pay up to the max 13K and any limit for the age of the kid? How can a 6-year-old serve on the board of directors? Who in the hell is participant? Are there cameras on? I'm not answering unless it's on. Is that Stephanie? Steven? Participant? Come on, throw in a name there. I need to know, where are you in Texas?
I'll ask it for them. So
That's me.
I'm curious. Okay.
I'm sorry, you were on mute. So, participant, you want to ask your question directly?
Sure. That's me, Tracy Kaffer. Can we pay up to max 13K and any limit for the age of the kid? Because I only have one kid, I don't have 4. So maybe we should have more kids for this reason.
No.
That was funny. See, that was very funny. I want to hand that to you. But once they become teenagers, no deduction is worth it. Not at all. No, right? I mean, when they're under age 6, they're adorable. You're like, oh, this is great. Then they become teenage daughters and you're like, holy shit. And then when they turn 22, they love you again. I've been there. And twins, 3X. All right. Okay. So now tell me your first name.
Tracy?
Gracie. Okay. Nice to meet you. What state are you in?
Ohio.
Okay. Ohio. I love it. All right. Here's the thing. Gracie, I would ask it differently. Can we pay up to the max 13? Whoa, whoa, whoa. I never said that was the max. I just said you could pay them up to that and they're not going to pay income tax. I had a realtor broker in Seattle 2 years ago out of their S-corp pay their 17-year-old $40,000. I was like, what the hell? That's going to get audited. They're like, he's a licensed realtor at age 17. He had 5 closings. But the problem was they W-2'd him. So we undid the W-2, kicked it out through the family management company the way it should have been done because his accountant jacked it up. They got a refund of $6,000 because they never had to withhold the FICA, but they did. So the point is, Gracie, I don't care about the 13 grand lower or higher. Number one, you have to pay your kids a reasonable comp for their age and what the hell they're doing. Number two, I'm not going to put a 6-year-old on the board of directors. I wait till they're about 14 or 15 teenagers because teenagers know everything anyway, and you want them on your board because they'll tell you what an idiot you are. And then you have to listen because apparently you're an idiot and they know everything. Okay. But when they're 6 years old, Molly was my little paper shredder administrator. She was adorable. She even got employee of the, I'm not kidding. I still have it in that box of remembrance where she earned employee of the month and she was able to park her bike in the garage in a special spot for being employee of the month. So kids can do janitorial. They can stuff envelopes. They can clean rental property yards. They can do paper shredding. And I might pay a 6-year-old 2 or 3 grand. Then they turn 10, I might pay them 4 grand or 5 grand. Once they're in high school and they're helping out in the business, pay them whatever the hell you want. Don't be hung up on the 13. Jennifer's lucky she's in Texas, no state tax. So we're just saving FICA and then we got the federal tax savings. Now, you want to go next level, Gracie? Oh, you're going to love this. I'll use this. This is level 1. Just pay the damn kids. Quit paying for it yourself. So how old's your kid, Gracie?
6.
Oh, I love it. He or she?
She.
Oh, good. Oh, good. Good luck in 10 years. Okay. So anyway, what you want to do, okay. 6 years old. She's going to clean the office. She's going to paper shred. You go hire a service. That's going to be $100 to $200 a month. So I might pay her 2 grand. I've had clients pay their kids that are 4 or 5 years old, 5 grand, put them on their website, some brochures, this and that, modeling fees. It can be a little more. I've never had a client audited for paying their own kids, ever. This is the New York City deli paying their kids after school, the Oklahoma farm on the cornfield, the Idaho farm on the potato field, realtors paying their kids to clean rental properties in the office. It's okay. This is the American way. These stick up your butt accountants that are so afraid to take a write-off, get rid of them. Ugh. Okay, next level.
So Mark, quick question for you.
Oh,
So-
Daniel, 1 second. You're going to love this next level. I'm coming back to you. 1 second.
Okay.
Gracie is going to pay her 6-year-old $2,000. Oh, well, that's earned income. No tax, no federal, no state, and you got to write off for $2,000. What can she do with that $2,000? Pay for school lunch? What, Gracie?
Put in a 401k for kid.
Ooh, close. No 401k. That would require a W-2. Roth IRA. Now with earned income, she can put $2,000 in a Roth IRA. Then when you go to do your next real estate deal, Jennifer, her Roth IRA is going to be a partner in your next LLC.
Oh my God.
This is called self-directing, next level. So not only do we want to fund the retirement accounts, we're going to be putting the kids' retirement accounts along with our own and our spouse in the LLC to go buy more real estate. I just got a tax write-off with no income collected to fund a Roth to fund my next real estate deal. Boom. She can pull out that $2,000 for college tax-free or continue to let it roll. Right now, if you have a 15-year-old and you simply put $500 a month in a Roth IRA, if a 15-year-old, at age 55, it'll be 3.2 million. Did our parents teach us that one? That 6-year-old of yours, she should be putting away $2,000 a year on a 10% ROI. Holy crap. Age 45, it'll be 2 to 3 mil. And she's going to be investing in your real estate along the way. Boom. Okay, Danielle, back to you.
Well, I can't remember. I'm so dumbstruck. I don't remember what I was going to ask you there, Mark.
Sorry.
So, but I do have a question. So, but this kind of goes back into the self-directed IRAs. What is the maximum we can put in into a self-directed IRA from a retirement perspective? Is it like 75K per annum?
Great question. Whew. Let me answer it this way. How much money you got? That's what a
Not,
good tax lawyer says.
Yeah.
I can do what's called the mega backdoor Roth this year and put away around 80 grand in a Roth IRA.
yeah, okay.
If you want to learn more about that, just Google Kohler mega backdoor Roth, Kohler. We have podcasts on it. I've got articles on it. It's called the mega backdoor Roth. Now, but there's stages, Danielle. For my clients, I just did a training earlier on this week with accountants and lawyers around the country. Over 100 CPAs on a call learning this for the first time. You don't learn this in school. You don't learn it on the CPA exam. You don't learn it on the bar exam. You got to get out there and be hungry to learn these street strategies. And this is where stick up your butt conservative accountants don't go. They won't do it. They think they know it all. It's my biggest problem in my industry is what I'm trying to do is get accountants to be humble and learn. Anyway, so I tell clients under 100 grand to 150 grand, just start with the Roth IRA. This year, you can put 6,500 if you're under age 50, 7,500 if you're over age 50. Then we can go to the 401k, drop in another 22.5. Then I can do matching. I can do an after-tax contribution. I can do if you're 50 or older, I can get up to 70 or 80 grand in a Roth per spouse. This is how the rich get richer. You start putting away 100 grand a year in a Roth. Oh my gosh. 10 years from now, talk about 3 to 4 mil. And you can be buying real estate and doing notes, short-term financing, long-term rentals, short-term rentals, all in that Roth.
And that's tax deferred.
No.
Pardon?
It's tax deferred,
Tax-free.
free. Oh, the Roth?
Okay, let's do 2 things.
Oh,
I'm going to try to bring this together in 10 minutes. I'm going to do the Roth. I've still got to go back to Jennifer on the LLCs. And then I think it's Gracie, who's kept her camera on, God bless you, is going to talk about paying spouse. I'm not even getting to real estate professional today, whole other topic. Okay. First, 3 boxes. You want to write this down? All right. Think of a 401k or an IRA. If I put money in a 401k or an IRA, do I generally get a tax deduction? If I got a day job and they put money in my 401k, do I pay tax on that? No, it's tax deduction. If I put money in a traditional IRA, I get a tax deduction. If I if I defer in my 401k at work, it comes off my paycheck before tax. No tax. Love that. I mean, a tax deduction. Now, if I invest my 401k in Tesla, Apple stock, real estate, notes, because I can self-direct my 401k. So I invest my 401k in whatever the hell I want. Do I pay tax when I make money in my 401k? No, it's tax deferred. But when I turn 59 and a half and start pulling money out of my IRA or 401k, do I pay tax? Yes. Okay. Okay. Still tax deferred. It's better than nothing. Not my favorite. Now let's say I do a Roth IRA. When I put money in a Roth, do I get a tax deduction? Do you guys say yes or no?
Yes.
I don't know.
No, bless your heart. Turn off your camera. You're cut off. Okay, now I'm just joking. No deduction when you put money in a Roth. And you can have a Roth 401k. So no deduction. I have to pay tax first. When I invest that Roth in Tesla or real estate, do I pay tax? No. A Roth IRA can invest in whatever the hell I want. A Roth 401k, no tax. I could do a 10, 20% ROI, buy real estate rentals, no tax. But is it tax deferred? What happens when I pull money out of my Roth at 59 and a half?
Pay tax.
No tax. It's
Based on
tax free.
But based on the cost basis or based on the whole thing?
Whole thing.
Ah,
This is where last year, Joe Biden in 2.0 was trying to limit Roth IRAs because who had a $6 billion Roth? $6 billion Roth. He started with 100 grand. Peter Thiel, PayPal, Facebook. He started with 100 grand in 1999. It's worth 6 billion. Tax free. He'll never pay tax on it ever again. You can do the same thing. I have realtors and contractors, developers. Use your Roth to build it. You'll never pay tax again. Roth. Now, wouldn't it be nice if you could get a tax deduction on the way in, tax-free growth, and pull it out tax-free? And you know what? Let's pull it out at any age. I don't care if you're 59 and a half. Wouldn't it be amazing if we could find this one vehicle that I could put money in and get a tax write-off, tax-free growth, pull the money out anytime I freaking want? It exists. What's it called?
Solo 401k?
No. Solo 401k could be here or here because you can have a solo Roth or a solo traditional. What can I invest in that grows tax-free, gross tax? I can self-direct it in anything I want. It's
Real
not
estate.
insurance companies. They're evil, as bad as hospitals. What else?
real estate.
Health
No.
savings account.
Oh,
The health savings account can invest in whatever I want and come out tax-free tomorrow, next year, the year after. They are the creme de la creme. You can have them no matter how much money you make and invest them. I have an HSA that owns a rental property in Illinois. I have an HSA that owns cows on a farm in Idaho. I can invest my HSA in anything I want. My rental property and my HSA paid for Molly's braces, my 20-year-old. I can pull it out anytime for healthcare. I have clients closing on rental property with their health savings accounts. This is why you 13 people are the smartest people in your damn group today, because this is it. I won't be back. You got to learn this, study it, and be the captain of your ship. I'll get you to law. I have 14 lawyers, tax lawyers that are booked out a week out. Not that bad. You can meet with at any time and build your own trifecta and a structure and your 10 things that you're going to do before year end and what your plan is for next year. It's not, we charge like $1,500 for a review of your tax return and build your trifecta. You need a new entity in that. Jennifer, you get an entity, a trifecta, and a consult with a real lawyer. About, I think it's $1,600. We'll get it's very affordable and you're off the races. All right. Now, before we go to the spouse, oh my gosh, I forgot your name. Martin, but
Gracie.
Gracie. Okay, before I come to Gracie, I'm gonna promise Jennifer this. Let's go to asset protection. Got my trifecta. Always starts with the trifecta. I'll show you a trifecta here of some clients here in a minute. Revocable living trust. How many, can you mind sharing, Jennifer, how many rentals you have?
4.
Or, okay, good.
And my daughter, who's 28, has 2
Okay, a part owner with you or just her own?
on her own, but I gave her the money to get the down payment, but that's a whole nother thing. I'm thinking I wish I would have done some other things, what I know now.
We should have maybe 1099 her, huh?
Yep,
Because you know, write off for a gift, but now
Yep.
you know. Okay.
right.
Now, so you have 4 options, Jennifer. So important. Option 1, you take one LLC in Texas and you put all 4 rentals in there. You have a calendar for me? Can you have me that calendar? Right? I got to look at Texas rules real quick. I publish a calendar every year. It's the 4th year. So Mark J. Kohler 2023 calendar. I have cheat sheets in here on all the state rules, little maps of all the different states, and I have to look them up constantly too. Oh, you're going to love this Texas rule. All right. Okay. So option 1, or I could set up 4 LLCs and put a rental in each one. And depending who you go get your advice from, you might get option 1 or 2, right? So what's the benefit of option 1, Jennifer? What's good about option 1 versus option 2? I may sound dumb, but I want you to say it out loud. What's
It's
the
cheaper
benefit
to
of?
set up 1 LLC versus 4.
That's right? Save
Mm.
money.
Yeah,
Super easy. 1 checkbook, 1 LLC.
yep.
What's the con compared to this one? More
More
con.
liability with just 1, because all 4 are grouped into 1 and they're not separated.
That's right. All eggs in one basket.
Exactly.
Perfect. And it's hard. And so what I tell clients is, if these are all strip malls worth of 1.5 mil, 4 LLCs. They're all low-income housing, 150 grand a piece, 20% down, go here. It's not about quantity. It's about quality and risk. Because you can say, those are 4 rentals that can sit all in the same. No lawyer's going to want to liquidate those. It's not worth it. But if these are worth $1 million each or 500 each, I don't know. Right? So that's what the lawyer would analyze with you. Well, how much equity is involved? Are these college rentals, low income housing rentals, little grandma rentals, short-term rentals on a golf course in a mobile home park? Don't know. So we'd figure out what is best. That's option 1 and 2. Option 3, we can do what's called a series LLC in about 15 states. I can set up 1 LLC, which we love. And then I can set up baby subs at no extra cost and get protection as if I went with option 2. So I have 1 tax return, 1 LLC. I will have different checkbooks. These all have different names. So I've got different checkbooks, but it's 1 consolidated tax return, 1 LLC, clean, easy. And I have protection for my 4 rentals called a series LLC. Texas has series LLC law. If you want a series LLC, I think we charge $200 or $300 more because there's more paperwork, but then we give it to you on a silver platter and you can set up all the subs you want. Here's the states that have series: Alabama, Delaware, DC, Illinois, Iowa, Kansas, Missouri, Montana, Nevada, North Dakota, Ohio, Oklahoma. That's good for you, Gracie. South Dakota, Tennessee, Texas, Utah, Wisconsin, Wyoming. If you're in a series state and you have more than 3 rentals, I'm going series. Cheaper, easier. Danielle.
Mark, so I have investments in Colorado, California, and Texas. So no bueno, right?
No. It's all good. I have rentals in 4 states too. You have choices. You could do 1 LLC that's registered in Colorado, California, and Texas. It's called foreign registration, $200 to $300 a year. Still 1 LLC, 1 tax ID number. That could work.
Yep.
But then we're going to go look at value and risk. And I'm going to ask you, where are you going to buy your next property? What's your long-term plan? You're like, well, I'm going to sell that one over here. Well, then that's not setting up an LLC there. Well, that one, I'm going to buy 2 more in Colorado. Okay, well, let's go down there. So we can tailor, together we figure out the best plan.
Oh, awesome. Okay.
All right. The last option is when I have a client with maybe 10 properties, $1 million to 2 million in equity, and we got more exposure. I got teenage drivers. I got more exposure. I want to protect my rentals. See, when you get in most lawsuits, you're like, oh, they can't get the rental. I set up an LLC. Oh, the LLC protects you from the tenant. It doesn't protect the rental from you being a dumbass texting and driving. You're like, whoa, a plaintiff can get in my LLC and dissolve my LLC and take my rental in about 26 states. So now we got another level of, I've got so much equity up here. I got to protect the equity from me and my teenage drivers. Whatever. That's called a COPE entity. So what we do is we set up a COPE entity that owns all your LLCs that own your rentals. Sometimes you get lucky and the COPE is in the same state where your rentals are. Sometimes you don't. We're going to play with Jennifer for a minute. Woohoo! We get COPE protection in Texas and we get serious protection. So that way, if Jennifer gets in a lawsuit, they can't touch her rentals and she can do it all with one LLC. You know how many states have that? 1, 2, 3, 4, 6, 7, 8, 9. Only 9 states have that. Texas is pretty sweet. No state tax, total asset protection. Love it. You have big property tax, kind of sucks. Plus you can't walk in the grass at any time of year because they have stupid bugs, scorpions. I mean, there are more deadly insects in Texas than I swear in Australia. I don't know. It's like, I'm going backwards in time to go to Texas, but you like alligators, javelinas, all those cool things, whatever. Okay. Now, last strategy. I've got to go here, but I'm going to throw this out. Someone said, do I pay my spouse? I have videos on do I pay my spouse? This goes to the sex topic. I'm just joking. All right. Okay. All right. Here's what we do here. You've got your S-corp. So, Gracie, you got an S-corp? And a
Yep.
6-year-old, right?
Yes.
Okay, good girl. You want to make sure your payroll's dialed in. You're paying your 6-year-old $2,000. She's going to open a Roth before year end. And then you can put in $2,000 for this year and $2,000 for next year. So now you got $4,000 in there ready to play. You could throw it in a Charles Schwab account and then wait until you get a little more inertia and then partner up in your next LLC. If you want to go to directedira.com, that's where you can set up LLC. Sorry, you can set up Roth IRAs for you, your family, or whatever, directedira.com and self-direct. Our podcast is called the Directed IRA Podcast. 200 episodes on how to do this. You're going to love it. All right. Now, you got to take a salary, right, Gracie? And you take a K1. Just like in our last example. Let's say you bring in, let's do a different number. You bring in 200 grand, you spend 50, you net 150. I'd probably take 50 in W2 on 100 in K1. We just saved 15 grand in self-employment tax. Is that about what you're doing?
Yep.
Ooh, I love you, Gracie. Good job. But very common for a realtor situation, netting about 150 a year. We do 1/3 in payroll, 2/3 in K1. So she goes, well, should I pay my husband? I'm like, I don't know. If you pay your husband, doesn't his income come down here to the 1040? Well, Mark, I got a write-off to pay my husband. Okay, that's cool. But you ended up picking it back up on the 1040. So aren't you back where you started? And what did you pay along the way? When you pay your husband a W-2, what do you have to withhold?
That's why I'm not paying him. I just want to make sure I didn't miss anything.
Okay, hold. My earpiece is being a problem. You said you're not paying him because what?
I'm not paying him. I just want to make sure I didn't miss anything.
Okay. Well, you may be missing something. I'm not saying do or don't. I'm just saying what happens if you do. You got to withhold the F word. FICA. What the FICA? You got a little FICA running around the house and you got your husband. So right, Kate, little FICA. Okay. So W-2, FICA, that sucks. And you pick up the income anyway, right?
Yes.
Anybody want to tell me why would I pay her husband? It's not all bad. Why would I do it? Anyone?
Well,
Okay, well, here's what we're gonna do for
are we
Gracie
going
too.
back to the sex comment or?
I'm open to that. Okay, no, all right. Here's what it is. Before we even get to husband, the next strategy I'm going to do for Gracie, because we're going to pop $2,000 in a Roth IRA for her daughter. And I want to pop 6,500 into Gracie's Roth IRA. And we might even drop 6,500 into her husband's Roth IRA. So we're already putting 15 grand in Roth IRAs out of the gate. But Gracie says, yeah, but my husband's got a great day job. We're really building wealth with my money, buying rentals. What else should I do? Solo 401k. So now we drop in a solo 401k. You can do that on top of your Roth IRAs. So you're putting 15K away in Roth IRAs to be partners in your next real estate deal. And then you do a solo 401k. We're like, I have 50 grand in salary. How much can she put away? She can do 22,500 this year, plus 25% of her salary, which is 12,500. That's another $35,000. I dropped 15 grand in Roth and 35 grand in Roth or traditional. I can choose. That 35 plus 15, 50 grand could be a down payment on a short-term rental. That short-term rental is owned by your Roth IRAs and never pays tax again. Crazy? This is your money call today. This is changing your lives. This is a new direction.
I didn't know we can do solo 401k on top of the Roth IRA.
Yeah, sweet. Okay, but it gets better. Let's go next level. Next level. Husband. What's your husband's name?
Daniel?
Daniel. Okay, I don't know if Daniel's worth it, but we could put him on salary. What would be the perfect salary for Daniel? What do you guys think? Any guesses? It's okay, just guess. 50?
40?
What do you guys think? Keep going. Okay, I'll give you a hint. Reep, reep, reep. If Daniel can defer 22.5, we want to gross up his salary to do a deferral of 22.5. So I might pay Daniel 25 grand. He defers the whole thing. His W-2 is 0. You just got a write-off for 25 grand and funded his 401k. Are we forgetting anything? He's a good employee. What'd you do for yourself?
Bonus.
You did a match. You got to match all your employees. So now he gets 25% of 25 grand. So now we should drop another 5 grand in there. So there's another 30 grand in 401k money to go buy a short-term rental.
Oh, I need to pay my parent at this point.
Well, okay. Now hold it. The only time I talk about this is if you're already paying your parent. See, if you're like, I'm supporting my mom and dad, Danielle, where do they go? On the what? Board of directors. So if you're supporting your mom or dad, you go, you just got a new job. You're on my board of directors. I need your advice. They're going to love it. I mean, from an emotional standpoint, seriously, you call up your mom and dad, you know what? I need your advice. I want you on my board of directors. You know how cool that feels?
And it secures you in the will.
You get better asset protection. You get a write-off. You connect with your parents. And you're helping them out in the most strategic way. And you're asking them for advice about your business. How crazy is that? So, last twist. Let's say, does Daniel have a day job?
Yes,
Okay. Does he have 401k matching at work?
probably. I don't really touch that.
Yeah, right. So now you're like, man, I'm a whole freaking all of a sudden interested in his 401k at work. So you call tonight at dinner, you're going to go, hey, Daniel, how much do they match on your salary? He goes, well, they do a 5% match. So if his salary is 100 grand, they'll match up to 5. So what do? He can have 2 401ks. So he's got his day job 401k where he defers 5 grand and gets the match for 5 grand, doubled his money. So he puts in his match for 5. The company puts in the 5, and then he goes, thank you, I'm out. and he goes and joins you and does the rest of the 22.5 down here. Because you can use this money to buy a rental property. Up here, I'm stuck at freaking Fidelity. So I double my money up here with the match. I call it matching out. Articles on that. Matching out. And if it wasn't that painful listening to me today, trust me, I try to make my YouTube videos fun and my articles interesting and readable. You guys have got to captain your ship. Your accountants are not going to do this for you. This is your world, your future. Accountants are jerks half the time. Go in there with that mentality and bring them along. Okay, so finally, I'll say this. If you want to write this down, I'll put it in the chat too. If you're looking for a new accountant, go to my website, markjkohler.com, and click on the Tax Advisor Network. I have over 300 advisors around the country that I train. At 4 o'clock today, I'll be training over 100 accountants to speak Mark Kohler. You can choose one of them wherever the hell you are. I don't care if you live in Texas and hire in New York, live in Florida and hire one in Alaska. Find an accountant that speaks your language and cares about you and knows these freaking strategies. They have to take 800 quiz questions, 72 classes, 12 modules to be certified by Mark Kohler. And they have to participate in a weekly training. That's the certified advisor you want. Number 2, start with a lawyer consult. Get with a lawyer and go, hey, give me a plan. Assess my situation. Jennifer's going to go, oh, I got this rentals. How many LLCs do I need? I got my S-corp. What should my payroll be? How do I pay my daughter? La, 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 la. Just today. She's got like 10 talking about it. Enrollment period starts in a week, November 1st. Are we doing an HSA qualifying policy? What are we doing for healthcare? Guys, I do this. I have a 3-day conference in Phoenix. If you guys want to come to it, it's $500 general admission, $1,000 for premium. 3-day conference, November 30th, December 1st and 2nd. I wasn't even going to bring it up. If you want to come, come. But I've got a 3-day conference on 30 topics. This is how critical this is. So get to kkoslawyers.com. I would recommend you do the comprehensive consult. If you want an entity, you can do a comprehensive estate plan, comprehensive entity, or a tax return review.
Can we just have a consultation with one of your CPA or whoever, and then just ask our own CPA to implement it?
Ooh, repeat that one more time, Gracie, a little slower.
Can we just get a consultation and then bring the finding back to our own CPA and just make him implement it?
Yeah. Now, I'll forewarn you. Yes, I want you to do that. Do the consult, get an estate plan, get an entity, get your tax return reviewed, get a trifecta. Let me show you what one of them might look like. This would be what it could look like.
So Mark,
can you make me a co-host, Danielle? Okay, but here's the problem, Gracie. Let's get serious. You go to a tax lawyer that gives you a trifecta and a plan, and you show up at your accountant's office and say, do this. They may go, thank you, Gracie. I don't know everything. I would love to learn more. I'll do what you said. Thank you. Or I've had many clients go and they go, the accountant says, oh, you don't trust me? Why didn't you call me? What the hell? I'm not going to do what that guy said, because they have to edify themselves, not look like a dumbass, and they're going to have to explain why they didn't bring you these strategies. That's not a comfortable conversation for them. So the only option they have is to discredit the plan or get on board. So Gracie, good luck. Now, if it's your sister-in-law doing your taxes on TurboTax for a spaghetti dinner, fire her. Would you up level, for crying out loud? Just a thought. Jennifer, I love your attitude. You're in on it. Okay, check this out. Here is, oh, I'm still disabled. Make me a co-host, please.
Well, Mark, I just want to recognize that we're past the hour. So
That's okay.
I don't know if you have something else going on or.
Oh, that's nice of you. I'll just show you this last slide. You guys want to leave? You can leave. I mean,
well, I'm trying to figure out why I can't share my, give you control here.
I'll go for one more minute. Yeah, just make me host and I'll just share my screen. I want you guys to see what you'll get with an attorney if you wanted to get something like this.
Let me get you host.
Let's try it here. Thanks, Danielle.
Did that work?
If you just click on my 3 buttons and say make co-host, that's, you just have to do the 3
That's
dots.
what I'm trying to do here, Mark.
Oh, I know what you need to do.
Host and
Did
co-host.
you click on the one where my face is, not the video? The Mark Kohler face one.
Oh my.
Mark
Lord.
Kohler laptop. That
There we
one.
go.
There we go.
Make,
Boop. Thank you. I should have said that. So the Mark Kohler laptop where it's just my face,
yeah,
3-button, make co-host.
I'm trying here, co-host.
Oh, it's okay.
There you go. You should be in.
Okay, 1 second. Dun, dun, dun.
And everybody, again, Mark's time is extremely valuable. And so I recommend just plopping down a couple grand to get all of these consultations. And I want to hear about it once you get it done, because I'd love to share some stories about some of our successes as well.
Well, thank you. You guys, yeah, or find someone like us. I don't care. I didn't come on to sell you guys, just give you some options. Well, having a hard time getting in here. So it's okay. I just wanted to show you a visual of what to look at. And thank you, Danielle, for your patience. I just keep hitting share screen and it's saying I can't, disabled. I don't know. Anyway, okay. Well, in sum, everybody, thanks for having me. Danielle, thanks for having me. And
And I'm going
check
to
out our
share,
podcast, Main Street Business Podcast.
Yep.
YouTube, get over to YouTube. Say what?
I'm going to share.
Yeah, I
this
told them about
video.
taxandlegal360.com. Oh, did they get, how much do they get off? Really? Ah, that's too much. Taxandlegal360.com. What's the coupon? You get 15%. Go 360.com. And the coupon is welcome back 15. All in one lowercase, one word. Welcome back 15. We have a room block. It's at the Hyatt Peak in Phoenix. It's beautiful in December. Who doesn't want to be in Phoenix in December? $150 room block per night. So super cheap. The VIP, we're doing a casino night. Friday night, we're doing denim and diamonds. That's right up Jennifer's alley. You could bring your cowboy hat, Jennifer. And like, we're going to be doing line dancing. It's gonna be
I love
kicking
it.
ass. Yeah. I'm going to be in, where am I at next? I'm going to be in Houston next Wednesday.
Oh.
And then Austin the week after that. Doing Amy Mahori's note class. And then I don't know, some other group in Houston. Anyway, normally my room's 400 to 500 people. So this is very intimate. Thanks everybody for having me. Danielle, I appreciate you. And thanks for letting me go over a little bit. I just wanted to wrap up those topics.
Thank
Thank
you
you.
so much.
Sorry, I didn't get into some of the questions here. I guess I missed a couple, but lots of good stuff. Get on YouTube, just subscribe. I go live tomorrow. I go live at 3 o'clock Mountain or Pacific. 3 o'clock Pacific tomorrow. I'll be live on YouTube. What am I talking about?
The top 5 tax tips for the end of year.
Oh, top 5 year-end tax tips. Ooh, I know we'll be hitting the solo 401k. All right. Thanks, everybody. Thanks, Danielle.
Thank you.
See you guys.